and Holst. We are certified financial planners in Lakewood, and we give educational webinars like this one just to keep everybody informed about what's going on. So per usual, if you have questions, you can chat them into the chat box on the right-hand side. We do have a handout for you today. You'll have a button where you can download that. If you're watching this recorded, there will be links on the page where you can click the handouts. Obviously, you can't chat in a question, but we're going to get started here. So welcome. So about us, I kind of covered it there. Certified financial planners in Lakewood. There's our team there, our Christmas photo. We need to get an updated one, but that's okay. All right, what just happened? So the first thing we're going to talk about is the OBA is what I'm going to call it. The One Beautiful Bill Act.
Yeah.
Yes,
Beautiful.
the OBA. Signed into law July 4th. By the president. It went through all of its necessary channels through Congress and the Senate, and it's been passed into law. So we're going to spend a lot of time covering some components of it. It's thousands of pages. So obviously we're not going to get to all of it today. And some of it we are still trying to understand and digest. So
you'll be hearing more from us about it as time goes on.
And we apologize if we're not perfectly accurate, but the information we have today is to the best of our knowledge on how to interpret the bill and how it affects you. So it covers a lot of things: taxes, spending, retirement, Medicaid, and more. It's the biggest policy shift since the Tax Cut and Jobs Act of 2017. And a lot of the changes are just making the Tax Cut and Jobs Act permanent. So a lot of it will be a continuation of the previous legislation. So we will get to all those little updates. Okay, so tax brackets are permanent. So we had a little confusion on this. If you talked to us in the last few weeks, you might have heard something else. But the tax brackets are permanent. So 2017 and previous, we had different income levels and different percentages per income level. So the good news is that these lower levels, the percentages, I'm going to share this with you now.
Excuse me.
Bless you. Limitus. So these, I'm going to share this handout with you now. This is the 2025 tax limits. These will be very similar for 2026. They will be indexed with inflation, so they'll go up a little bit. Yeah. But the important thing is that the brackets, the percentages will stay the same. So the first one is 10%, the next one is 12%, the next one is 22, 24, and on. Those will remain the same.
And those are ordinary, it's taxable income brackets. There's 7 of them. So that's after, when you have all your income, you subtract either your itemized deductions or the standard deduction, you get down to taxable income. That's what we're talking about.
Yes. So that makes things simpler for everyone. And they are definitely more beneficial than the previous brackets, 2017 and behind. Before. There we go. Definitely better for most people.
Yes.
Smaller amounts, smaller percentages, and lower levels. So that's good. We like that. Yes, there has been a child tax credit increase. So for every kiddo that you get to claim on your taxes, instead of $2,000 credit, you have a $2,200 credit. So an extra $200 per kiddo in tax credits.
That's great.
That's good. Expanded SALT cap. This is state and local taxes. So for those of you who itemize, the cap was $10,000. That's the most that you could add into your itemized deductions. That has been increased to $40,000. So that's a benefit to those who are itemizing for their taxes. There is a limit. It's for incomes that are less than $500,000, and that expires in 2030. There are a lot of these rules that have windows that we'll talk about. Some of these things are permanent, of course, what's permanent, but some have windows. This one is a window for 2030.
Yeah, and that helps people who live in higher states that have higher taxes, like property taxes, income taxes, all of that, that benefits both coasts probably more
The
than
coasts,
anything.
yeah, as you guys know, probably living in a lot of you, most of you in Colorado, that our property taxes are
Oh,
relatively
yeah.
low.
Wow.
Um,
Yeah, compared to New
compared
York
to some of the
where I'm
coastal
from,
areas.
yeah.
So this may or may not benefit you, but some people it's a big deal. Trump accounts. This is the new thing. You've probably heard about this. This is for babies born 2025 to 2028. You can apply to get $1,000 from the feds deposited into this special new kind of account just for having a baby. And you can add to it $5,000 per year. That's the limit. So it's going to sound kind of similar to the rules around IRAs and Roth IRAs, but they're slightly different. So $1,000, you have a baby, here you go, $1,000.
Okay.
You can add $5,000 per year. And then at 18, that's the magical age when now you can take some of that money out towards a qualifying expense. So what sorts of things do 18-year-olds need? Hopefully, maybe some college costs, but then also it's expanded to things such as buying a home for the first time. So let's imagine you get the $1,000 from the government, you put $5,000 in a year, you put it in the market, you can put it in the stock market. It's limited to
broad indexes.
So you can invest it in the market. Hopefully it grows for 18 years. And 18 years, you can take it out as long as the child uses it for qualified expenses. The money is taxed at long-term capital gains rates instead of ordinary income. So you get a little bit of free money and you get a little bit of a tax break.
And it's tax deferred while it's growing, right?
Yes, tax deferred while it's growing. So similar benefits to 529s and IRAs, just a slight shift. And again, that's only for babies for 3 years, 2025 to 2028. We'll see what happens in 3 years.
So I think that's pretty cool. Just encouraging savings at very early.
They're encouraging saving and investing and holding on to that money for adulthood expenses.
Nice.
So that's a new thing. That's pretty cool. Pass through business owners benefits. So this was just something that happened in 2017 as part of the Tax Cuts and Jobs Act that was made permanent. Qualified business income deduction. So that's for business owners that have a pass-through business, such as an S corp, an LLC, or
even sole proprietors.
Yeah, sole proprietors. Yeah. So if you have one of these business types and your income is within the threshold, I think it's 182,000 for a single filer, and then it's way up there, 360 something for married. 20% of your income you can deduct off of your taxes. It's kind of complicated. Do you know how to explain it better?
What's the profit? So after all the expenses are taken out, your wages, any kind of expense, whatever's left over is your profit. Of that money, 20%, you don't pay taxes.
You don't pay taxes on. Yeah. And speaking of don't pay taxes on, this one, the last one is a brand new one, tips and overtime deductions. So for folks who are working in a service industry, it might be receiving tips, or for people who are working overtime every week. So beyond the 40 hours of the usual work week, if you're working 50 hours or 60 hours, that's considered overtime according to this bill. That money up to $25,000 you can exclude from your income. So that really helps people who receive tips and who work overtime.
And that's based on a weekly, hourly kind of
for
thing.
The overtime. Yeah. For tips, I believe it's just
it's
all tips.
Yeah, I think so.
Yeah. So that really helps. Again,
That's great.
Your servers, your restaurants,
Everyday people,
your baristas, and those kinds of folks. Okay, so that's some of the new stuff. All right, you're going to talk about senior and retirement impacts. You are
my peeps,
for undisclosed reasons.
My peeps.
Your
peeps. Okay, so this is a really, really good one. That we are senior deductions. So if you're 65 or older, we have standard deductions and all that, but if you're 65 or older, you got $1,500 per person. So extra deduction off of your income. So income that doesn't count, that's not taxed. And so for married, it was $3,000, that kind of thing. Well, now they raised it to $6,000. Yeah. They raised it to $6,000 per person, or $12,000 deduction you add to the standard deduction. So that's huge. That's a lot of money that's not going to be tax income. And a lot of you probably already know that most of your Social Security, all of your Social Security is not taxable of the state of Colorado, but this is more of a federal thing. So we have a much bigger senior deduction that you add to your standard deduction. And there it is, 12,000. That's excellent. But your income can't be too high either. Single, it's all these things everything is linked to your income.
Most things, yeah.
It seems, yeah.
Most things.
So that starts this year.
Yeah, it starts this year. So I'm pulling up our handy dandy chart. We just shared with you the 2025 annual limits. So for a couple married filing jointly, let's see the. Yep. It's, this was for 2025. So it goes up a little. So it's about 31,000 for married filing jointly. That's the standard deduction. Then you add the additional senior 1,500 per person. And then you add the 6,000 per person, and it's over 40,000, 42 or something like that. So in total deduction. So that can wipe out a ton of your income.
And you might hear on the news that they're not taxing Social Security. Well, it's still, the Social Security taxation rules are the same. And we have classes on that, or call us if you have any questions. But it's not, that did not change. It's just they gave us a bigger deduction for the adjusted gross income before you get to taxable income of 12,000 per couple instead of 3,000. So 9,000 more of our income is not taxable.
Right. So that starts this year, which is unusual. Typically, we get a next year amendment. It starts this year, and it only goes for 3 years. So take advantage of it while you can. Make sure that your tax person, is aware of that. I'm sure they are. Or if you're doing your taxes yourself, make sure that you calculate that into your final numbers.
It's excellent. I love it. So
I'm sure you do.
I do. I'm just barely there.
Yep, just scratching the surface. Okay, so moving on to the estate tax exemption. So this estate tax exemption, that is how much you can exempt in your lifetime. It's a gift, and it's an estate tax exemption. So in your lifetime, you can give up to, right now, $15 million away as gifts, or after you die, and not pay any gift tax. So this was down a lot lower. 2017 and previous, it was about 7 million. So they upped it to 15 million with the Tax Cut and Jobs Act. This has been made permanent. So we don't have to worry about that 15 million going back down to 7 million, and it will be adjusted for inflation. This is one of the things that there are no income limits to. This applies to everyone. People get confused a lot when they gift. They say, well, if I give my daughter $20,000, for example,
can I do it?
Do I have to pay taxes on it? And the answer is no. But you do have to file a gift tax return, because there is a limit for how much you can give and not report it. Not how much you give and not pay taxes on it. That's a limit too. But most people will never hit that 15 million.
They just want to track everything.
They want to track it. So if you're giving more than, what's the gift limitation this year? 19,000. So someone could give someone else $19,000.
Someone, I think, did.
Someone could.
I think someone might.
I don't know who it was. But someone can give someone $19,000, and nobody needs to know about it. The IRS especially doesn't need to know about it. But as soon as you give someone $20,000, now you have to file a gift tax return. You do not pay gift taxes on it until someone gives someone $15 million and $1. That's when you start paying taxes, and it's a big one. It's like 40% gift tax. Yeah. So that was sort of a little side quest there. We're gonna go back here to RMD age, unchanged. Okay, so the RMD age, it's a little tricky. Right now, for most people approaching RMDs, it is 73. If you were born after 1960, it is 75. That remained unchanged. They're not going to change that, and they are going to study inherited Roth RMDs. There's a little side note. For some reason, if you have an inherited Roth, you still have to pay required minimum distributions, which doesn't really make sense because taxes have already been paid on this money. Hopefully they get rid of that soon. They haven't yet.
It makes no sense.
But that's,
you're not, you have to take it out, but you're not taxed on it because it is tax-free stuff.
Yeah.
So I wanted to go back on the RMD. We are just starting, we're going to look at all our clients like we do every year and look at all of your qualified money, which means IRA, 401k, whatever. And we help everyone calculate how much they need to take out before the end of the year. So you'll be getting, if you're a client, you'll be getting a phone call or an email from us so that we make sure we know we take it out. So there's no penalty of 25%.
Mhm.
And where are we going to put it and all that. So
we help you pay the taxes, and then we talk about where to put it. If you are of RMD age or approaching RMD age, please make sure that we are aware of all of your retirement accounts. If you want us to calculate your RMD, we need to know about the ones that even we don't manage because they are part of the calculation for your total RMD. But if you're in that group, you'll be hearing from us probably in the next month or so. We usually start late summer, early fall.
Yeah.
Okay, so that's it for this slide. Let's see what we got. Okay, Medicaid and SNAP changes. This probably doesn't affect a lot of you guys or your money, but I did want to touch on it really quickly. Over $1 trillion cut to Medicaid funding requires 80-hour work rules for adults. So the new law is saying that for people on Medicaid, they need to prove that 80 hours per month, not per week, because that would be pretty extreme.
Then they
80
get
hours
tax-free overtime.
So they need to be doing something. They don't have to be working. They have to be doing a community contribution event. So that means they either need to be working or volunteering, or they need to be in school for at least 80 hours a month to qualify for Medicaid. So this is people in the working age. I think it's 18 to 64. And there are, of course, exceptions for people who have disabilities, for young parents of young children, and people who are frail, is the way it's written.
Right. So if you're able-bodied and not one of those exceptions to get Medicaid, they want you working it's kind of like half-time.
They want you working or at least contributing to the community in some way. So this 80-hour rule also applies to SNAP benefits. So basically, if you're able-bodied and you are requesting benefits, you need to be proving that you're contributing to the community 80 hours per month. So that's the gist of it. There's some other things. People have to requalify every 6 months for Medicaid.
And SNAP is what? Food.
The food benefits. Yeah.
Yes.
Mm-hmm. I can't remember what it stands for. Somebody probably knows. Yes, food benefits. So, and then they're going to reduce some of the SNAP benefits. They're not going to allow things like sugary drinks and prepared desserts are going to be excluded from SNAP benefits. But then the Medicaid I was touching on, they have to requalify every 6 months. And then it's a little bit more difficult to apply. So they're just trying to sort of limit some of the access to these programs. There will be pros and cons to that, I'm sure. Mm-hmm. Okay, clean energy and credit rollbacks. EV and solar credits end by December 2025. So if you had your eye on that electric vehicle or those solar panels, you better get on it because those credits are going to end at the end of the year. I think in totality, I'm pretty sure there could be some small exceptions, but for most consumers, the federal tax credit on the vehicles will go away. Remember, it was reduced to vehicles that were made or assembled in the U.S. That was the more recent update. Now it's just going to be all federal credits. Now there are state credits, so that can still potentially incentivize you to purchase an electric vehicle and potential solar as well. But definitely get on that if you are considering it. When does that go in effect? Susan says, sorry, Susan, I just saw your message. What is that? Are we talking about my previous slide or the current slide? The current slide goes into effect at the end of the year. Previous, okay. Medicaid and SNAP changes. I believe this is 2026.
Next year.
Yeah. So rules will begin at the beginning of next year. I'm pretty sure. That's a sort of general answer, though.
Yeah, because I put a lot of stuff in this bill thing.
It's huge.
And so they have to work out a lot of details of a lot of things yet.
Yeah.
So we'll be updating as we learn more things.
Yeah. Okie dokie. Okay. So Susan got thumbs up. All right, great. So that's pretty much all I have to say on the Medicaid and SNAP funding and the rollbacks. We already did that. Okay. So 2025 could be a tax planning year If you are itemizing, it certainly could be because of the state and local tax deduction increased. The child tax credit enhanced, $200 extra per kiddo. And then this one, just threw that in there, charitable giving deductions for itemizers will have a floor. So that means that only gifts that add up to more than 0.5% of your adjusted gross income are deductible. So that means there has to be a certain substance to the gift in order to deduct it. If you are itemizing and deducting your charitable giving.
And as we've talked about many times, there's something separate called the QCD,
Qualified charitable distribution.
Which you take money if you want. If you're 70 and a half or older, you can take money out of your IRA and have it. And we help our clients do that and give it directly to the charity, and that you're not taxed on that.
Nobody's taxed on it. So it's a great way for people who are 73 or older who know they need to fill an RMD requirement, but they don't want to pay the taxes, but they also want to give. You can just send the money directly to a charity. There is a limit. It's
It's a little over
108,000. Maybe I'll have to double check.
It goes up every year.
It's on your sheet that I just sent you. So for those of you who have really, really big IRAs, maybe you won't be able to fulfill the whole requirement with it. But it's a great way to give and avoid paying taxes and meet your RMD requirement all in one swoop.
And your kids are not a charity.
It's true.
Everyone asks us that.
If you are interested in doing a QCD, come talk to us because you have to get it done by the end of the year and the charity has to cash the check before the end of the year. So jump on that. Don't wait until the end of the year. And you certainly can't wait until you do your taxes. It has to be done this year.
The calendar year.
Mm-hmm. Okay. So the markets, they've been resilient. That's the word we keep hearing. We heard volatile a lot in the beginning of the year, and boy, did we see volatile. And all the pundits that I listen to say they've been surprisingly resilient. We've hit some all-time highs. S&P 500 on July 3rd closed at 6,279. That's the highest it's ever been. The NASDAQ all-time high close was just over 20,601, also on July 3rd. The Dow Jones didn't quite hit an all-time high as of yesterday. I don't think it's hitting it today. No. There was a previous high in 2024, but this is really close, 44,828.
Yeah, it was 45 something.
Yeah. So the markets have been sort of adjusting to the tariff conversation, the constant back and forth, not reacting as aggressively as they were in the beginning.
Right.
So that's good, but it's important to remember that everybody, most pundits, most professionals are still expecting volatility this year. Just because of there's a lot of unknowns with the tariffs.
That's the big thing. Yes.
So we're stoked that the market is up, but we're going to remember that it's going to come back down sometimes. That's what markets do. They go up and down. So if we have had a conversation, or if this has been a thought in your head that you're thinking, my portfolio is aggressive and it's a little bit more aggressive than I want it to be, now is a good time to maybe rebalance into something that's more moderate or conservative because the market is high. So if you've had that thought, hey, I really don't like how my accounts have been bouncing around and your account's up right now. I know it's hard to sell winners, but if this is a thought you've had, give us a call and let's talk about getting you maybe into something that's a little bit less rocky, because these will continue to bounce.
And that's when you should make a change if you're going to, is when the market's rebounded. You don't want to change when it's low so much because you lock in the loss.
Especially if you've been thinking, I have too much aggression, there's too much volatility, things are going up and down too much. If that thought has been popping into your head recently, please give us a call. Let's talk about a different strategy for you that will be less bumpy and help you sleep better at night.
Yep.
Okay, let's see. Next slide. Okay, this is just a chart, S&P 500 last 5 years. We like to do a little history sometimes with these and show what's been going on. This one here, this dip, you can't see my cursor. The dip farthest to the right is Liberation Day. That was April 4th when President Trump announced tariffs and the market went down, rebounded quickly, as you can see. The dip in the middle, that big slow valley there, that was That was a response to the Fed increasing interest rates to try to combat inflation.
Yeah.
So that long slow dip in the middle was sort of the tough love we talked about, where we had to slow down the economy to decrease inflation. So that's what that was. And then back here at the beginning,
Way on
2020,
the
there's
left.
COVID on the left. Yeah, seems
Way
like
on the
ancient
left.
history now, doesn't it?
But you can see markets, they always pull back, and it's normal to have a correction every year. And bull and bear markets happen also. But in general, most of the time, 3 out of 4 years, the market's up.
Yep, 10% correction per year is a normal thing. So keep that in mind. Primary market movers, this one's yours.
Yeah, I mean, there's a lot of noise out there that moves things and temporarily, but the things that are really the most important that over time move the market are these things. Actually, it's interest rates, where they are, because companies have to borrow often to expand and things like that. So if it costs a lot more, it's hard for them to do that if they're borrowing, and people don't buy as much and all that, so that you're not buying as much from companies if you're borrowing, because a lot of people and businesses borrow. So if they're up way too high, it's tougher for that to happen. It's okay historically right now. It's a little higher than normal, and we're waiting for things to come down.
Interest rates. We've got some slides on all of these coming up.
Okay, so earnings is the most important probably, because that's announced every quarter. So we have more.
It's our GDP. We'll talk about that.
Unemployment's still really low. The growth in the country is decent. So these are the really important things. Right
Yeah. People tend to get caught up in the noise, kind of like she mentioned, the headlines. That's what people erroneously think moves markets. It's really these things that are the fundamentals, is what we call them. The fundamentals are sound. That's the moral of the story. Everything is pretty steady, and we're grateful for that.
Yes.
Inflation and interest rates. Inflation has been sort of steady around 2.8%, showing a downward but persistent trend. So the Fed, that's our organization that determines the federal funds rate. They're trying to get inflation at or around or under 2%. That's been the goal since COVID, right? Since they lowered it to 0 and inflation, the federal funds rate lowered it to 0 and inflation shot up
to 9.
So we've made some good progress. They're not quite at their target. So you hear probably a lot in the news, when is the Fed going to cut interest rates? Lots of strong opinions around that. But they've been trying to get inflation at or below 2%. It's not quite there. So that's sort of the short answer as to why the Fed has not cut rates. When the Federal Reserve cuts rates, why people are so interested in that is because it will help borrowers. So people who are considering buying a home, that's probably the biggest one for the consumer, is when can I afford a mortgage that is at a better rate than current rates? So the consensus is that there's two potential rate cuts later in 2025. This changes all the time. We're hoping that they will cut rates. It's at 4.25%, between 4.25 and 4.5. So that's what everything else is built upon, that federal funds rate. So if the Fed cuts rates, then our mortgage rates come down, our car loan rates come down, our business rate loans come down. So that's what we're hoping for, but we don't want them to jump the gun, because if they do, of course, that could cause
tariffs. Things are going to go up there, so that's a little bit what they're concerned about. But that's for the individual. For the government, it's the national debt, paying interest with our treasury bonds. When they have to renew treasury bonds, when they come mature, they have to buy them or sell them at a higher interest rate, and that hurts the coffers there.
Yeah. So I just skipped ahead to this slide just because I was mentioning it. Mortgage rates, they remain elevated around 6.8% for a 30-year fixed. So it's still pricing a lot of people out. Home prices are rising, but pretty slowly, 4 to 4.5% year over year, and inventory is low. So that's saying it's a seller's market still. There's not a lot of new construction. It's slowed down. Builder confidence is below 50%. So the moral of this story is there's not a lot of houses, and they're expensive because there's high rates. So there are not a lot of affordable options out there.
Countrywide, yeah.
Countrywide, yeah. So it's not a great time for the housing market, maybe not a great time to be buying or selling, but when people come in and say, when should I buy, when should I sell? We usually say, what's a good time for you? Because we can't predict these markets. What's going on in your life? Remember, you can always refinance if you have to buy something at a rate that's not ideal. You can always refinance down the road. And we don't know when these are going to change. That's sort of where we are right now. Backtracking a little bit to review of Q2 and Q1, GDP, gross domestic production, contracted by about 0.5% in Q1. So that's the growth of the economy. That happened because of the tariffs. People were sort of front loading. They were trying to get all their stuff.
More stuff was coming in.
Trying to get all their stuff into the country before the prices went up. So that kind of skewed our GDP. But the growth forecast for the rest of 2025, people are thinking it's going to be between 1.4 and 1.8%. That's the growth. That's down from 2.2. But then core CPI, that's another word for inflation, still it's around 2.8%. Unemployment is still near record lows, went up a tiny bit, but it's about 4.2%. So that's still relatively very good.
Historically, if we were 5% or below, that was a balanced, good number.
Yeah. So you'll hear things like unemployment's going up. Well, look at the big picture. What is that relative to? Relative to, history, it's still very low.
It's very low.
What I was hearing the other day is that it is basically sort of frozen. The job market's frozen. Employers aren't letting people go per se because they had a difficult time hiring them after the pandemic, but they're also not necessarily bringing people in. So the wisdom there was basically like, if you have a job, maybe hold on to it for now because you probably have some pretty good job security. If you're looking, things might be a little bit harder. If you're thinking about making a change, factor that into your logic for right now. But overall strength in the economy is what we're seeing, which we like. Expectations for 2025. Will the Fed cut rates? We don't know. 50 to 60% chance in September. I don't know. I heard that earlier in the year for June. So it really depends on what Trump does. He just announced some new tariffs for some new countries, but he also gave an extension. So it really depends on what sorts of deals are able to be made and, what he decides he wants to do. What do analysts expect for growth? It's pretty good. S&P earnings growth forecast 12% year over year. The S&P returns an average of 10% over time per year. So that's like above average. That's the strongest since early 2022. The things that are leading, the stocks that are doing the best, is going to be those more risky stocks. So tech, consumer discretionary. That's the things that we can buy if we have extra money. Communication services, those kind of more edgy stocks are the ones that are leading, as they typically do. So if you're in a portfolio that has some of the more safer stuff, some of the more defensive things that we talked about, things that do better during a recession or do better when we're sort of in a slump of a business cycle, those are not going to be performing as well. But that doesn't mean we want to change strategies. If your long-term goal is conservative to moderate risk tolerance, we want to stay the course because they will flip. They will have their turn in the sun, as they always do, and we just want to wait.
And they pay dividends.
So that's good too. So that means they're going to pay you even if the stocks aren't growing. You're still going to be getting money for being a stockholder, for being a dividend, a shareholder. Okay, Social Security Fairness Act. We've covered this before. Why don't you talk about this one? This changes our Social Security benefits.
Yeah. So this applies to people that worked sometime in their life in a job that they did not pay Social Security taxes.
So think teachers.
Counties, state, teachers, all of that. A lot. Paras, the big one. And then, a lot of counties and all that, if you did not pay into Social Security, where you were going to get some kind of pension, you got dinged. And it was either your Social Security benefit was dinged, and that was called the windfall elimination provision. And this other one, the government pension offset, is to get a spousal benefit from Social Security. That was dinged also. Well, they got rid of all of that. And it was retroactive to January of last year. So if that applied to you, most people have been notified, got a lump sum, and probably got an increase in their Social Security benefit. And you can check, Social Security for updates on that. But they're supposed to take care of everybody by like October. But the only reason they wouldn't know to take care of you is if you never applied for spousal benefits in the past, and that meant your pension was too high and you would not get a spousal benefit. So you didn't even apply.
So you're not on their radar.
You're not on the radar.
If that's you, if you didn't apply for Social Security because you didn't think you were eligible because of the government pension offset, you need to get on ssa.gov and you need to apply for Social Security. This has been the case. We've had a couple people come into the office that were missing out on money and didn't even know they're missing out on it, and Social Security office isn't going to reach out. So
so this is about applying for a spousal benefit. So call us if you have any questions.
And speaking of Social Security, if you're trying to log into Social Security, they have a new system. You cannot just log into ssa.gov anymore. You have to use one of these third-party ID checkers, login.gov or id.me. We have had some difficulty getting people logged into these. They can be very extensive on the necessities to prove your identity. Sometimes you have to provide not only your ID, but then another identifying card, and then you have to have a little video chat with someone at Social Security, and you show them your ID in the camera. So if you're trying to log into Social Security and it's giving you an aneurysm, you're not alone. Call us. We can help you approach it with some patience. This is a new thing, and it is there to protect you because there's a ton of fraud. A lot of people will log in and steal your Social Security check. It's not trying to hurt you. It's trying to benefit you, but it can be really difficult. So just prepare yourself and give yourself lots of time. And if you do need to get in the queue for this verification I mentioned, when we did it for a client, it took 30 minutes. We sat here, we waited for an officer to show up on the screen so she could verify her identity. So just plan ahead.
And it's new. I mean, it's all new system really because of all the fraud.
Yeah.
So there's going to be quirks and all of that, but it's kind of a pain.
We're here for you.
But we can help.
If you need help, we're here for you.
Yep.
Okay, you already got this sheet here. If you click on the right side, if you didn't click on it yet, handouts. This is the tax fact sheet download. This is about the end of our presentation.
Don't leave home without it.
That's right. Bring it to all the parties. Robert Donahoe, Joanne's lovely husband. Lovely. Does Medicare. Just like to remind you guys, if you need help enrolling for the first time or if you're switching plans, that's his email. You can give him, reach out and he can help you enroll. He does a really good job.
Crazy email.
I don't know why he did that.
I didn't.
Okay. All right. So this brings us to the end of our presentation. You guys have seen this before. We're comprehensive financial planners here. Yes, we talk about investments, but we also talk about income planning, tax reduction strategies, Social Security, estate planning. It all fits into the pie. It's all important. It all helps you retire happily at the end of the day. So if you are not a client and you want to reach out, we have a link here. Meet with us. Okay. There's a link to book at the bottom of the page. You can book with us for the first time, or you can book a call to help with Social Security, or you can book a call to tell us about your garden, whatever it is that you're up to. We want to see you. If you're watching this recorded, there should be a link on the page to schedule a meeting. Does anybody have any questions about all that stuff we covered?
It was a lot.
There was a lot. Yeah, it was a big quarter. A lot happened. A lot changed. Anybody, any questions as we wrap it up here? Melanie says thank you. Thank you, Melanie.
Welcome.
Hope everybody's having a lovely summer.
Yeah.
Staying cool out there. Growing some veggies. We'll have veggies in the office
There's
per
Leslie.
usual.
Hey, Leslie.
Hey, Leslie. Come on by the office. We're starting to produce.
Oh.
By we, I mean
me. Yes,
she.
I just brought a lot of yellow squash, 8-ball zucchinis around in regular zucchini. So we're bringing the stuff in. So give us a call.
Stop by the office, grab some vegetables. Because nothing says money like zucchini and tomatoes.
Oh, and broccoli. Oh my God, we have so much. I have to bring that in.
Oh boy.
Not tomatoes yet, but.
Oh, thanks, Lindsay. You're the best.
Oh, thank you.
Oh, Leslie's coming in for veggies. Okay.
All right,
cool.
Leslie. Yes,
Yay.
we miss seeing you.
Okay. Well, if there's no questions, we'll sign off. Thanks everybody for joining,
Yeah.
and
Take
we will
care.
see you next time.
Okay.